I'm Jeff Garten. I teach here at the Yale School of Management, and it's an enormous privilege for me to be able to moderate this panel on the future of the global financial system. We picked a very modest topic, but we have actually 6 people here who are beyond well qualified to discuss a lot of aspects of this. I don't really have to introduce them. You have all the background in your programs. But between Paul Volcker, Bob Rubin, Sheila Bair, Roger Altman, Gary Gensler, and Bob Zoellick, we intend to have a very broad-based discussion about the global financial system. And we're going to define that subject very broadly. It's the monetary system, of course, but it's beyond that. It's about banking. It's about regulation. And it's also about aspects of the real economy that underlie the financial system and how it works. I think everyone understands that global finance is really the circulatory system of the world economy. You can't talk about growth, you can't talk about trade, you can't talk about all kinds of human progress without ultimately coming to grips with global finance and how it works. I think we also all know that this system has been responsible for the greatest spurt of prosperity that the world has ever seen, but it has also created horrendous problems and caused enormous dislocations. So we want to come to grips with several of the aspects here that are relevant to business and society, and also relevant to graduate management education. The plan for the 90 minutes is that we will take the first half hour, and I'm going to pose a question to each of the panelists. Be a broad question. In the second 30 minutes, we'll talk about some very specific issues. And then we will open it up for the third half hour to questions. And I hope that you will be thinking about what you'd like to ask this distinguished panel. So I'm going to start with Paul. And Paul, you can use this. Yeah, you can use this. I'm going to start with Paul and really ask the question about the monetary system itself. I have heard you describe it as a non-system, and to bemoan some of the real defects that comes with a non-system. You have all of 4.5 minutes to explain what that means.
Well, it's such a good system, I only take a minute or two. But no, I was interested in introducing it. You talked about the global financial system and trade and transactions are going on in a volume never went before. And it's called a system, but you mentioned the monetary system's kind of at the center. And we have a financial system without a monetary system, in my view. If system means you've got certain rules of the game, you have certain disciplines, you got certain framework that people follow, we don't have it. It's a free-for-all. In the monetary system, people do what they want to do. And you can question, you can call it a system if you want to, but it's not a disciplined system. It doesn't have any very clear rules. You know, a century ago, we had the gold standard, and that was a system, a pretty simple system, but people knew what the rules were. It was, I don't know whether it's a monetary system or a religion, but people said, no, you've got to maintain the value of your own domestic currency in gold. And if everybody does that, exchange rates are all fixed, and you don't have controls, things move around, but you have to obey the disciplines. If you lose gold, you've got to do something. If you've got too much gold, you've got to do something. We had the Bretton Woods system after World War II when the gold standard broke down. It was rather an elaborate system, negotiated system. But there were certain rules. The rule was you maintain the value of your currency as long as you could anyway. And you maintained open trading system. You had big argument at Bretton Woods about how disciplined the system would be, but it had disciplines in it. That broke down. And then we had a fashion that said, well, if everybody floated, that's a system. And it's got its own disciplines. And if your currency goes down, you'll act. If it goes up, it would be very smooth. I mean, wonderful sermons were preached about this with Milton Friedman and others. But I discovered that didn't work very well. It was very unstable in the end, and people didn't follow the essential rule, which was let your currency float freely. Now some people let it float, some people don't, whatever is convenient at the time. But when you're talking about a system, particularly a monetary system, you are not, any individual country is not independent of what it does, because whatever it does affects others. And you can't have, everybody can't have an exchange rate, because you always got an exchange rate against somebody else. And if they're unhappy, you're unhappy. But you have more countries than you can have exchange rates, because in case two people have an exchange rate, and by definition, it's two-sided. So what do you do? I think the lack of a more organized international monetary system played a part in the Great Crisis. That's not a very widespread point of view, but I think it's in a very underlying sense. It did have something to do with it, and illustrated particularly by the United States and China. Here are the two big countries. The United States, dominant 15 years ago or so. China's huge and rising. But who, if you sat there in the year 2000 and said China is going to build up $3 or $4 trillion of U.S. government securities and finance half of Mr. Rubin's deficit? No. Yes.
Well, Paul, with all due respect, we had a surplus.
I understand, but what can I? But see, subsequently, after Bob Rubin left, the discipline was gone, and we could borrow forever at cheap interest rates, very cheap interest rates, in a booming economy. People said it's great. We'll make up phony mortgages and no down payments. We don't have to worry because everything's so easy. All being financed by China. Now, it's comfortable. Who wants to complain about indefinite borrowing at 2 or 3% interest? But the dollars, so much of our Treasury debt and other debt now is held abroad, and China isn't the only one. But I raise a question for you, because this is a question of the monetary system. The dollar is the world currency. Not quite as dominant as it used to be, but still pretty dominant. But how long can we go on borrowing from other countries who are holding dollars in very liquid form? Is at some point that going to come out to haunt us? If you have any serious lack of confidence in the United States, you're going to be in big problem with that amount of overhang of dollars in the world.
Let me stop you there, because I want to come back to this subject.
Okay, I'm finished.
No, you're not
That's
finished.
all I know.
No. Bob, I think is a really good segue, because...
I actually don't know it. It's all you think.
Give this Bob.
Make a slight distinction.
Bob, you and I talked about the underlying U.S. policies, because if the U.S. is at the center of the global economy, even if it's diminished, what's underneath it? How should we think about fiscal policy? How should we think about these kinds of things in terms of the U.S. role?
Yeah, I'll do that. But let me just say one word. I think we have a lot of different things to discuss this panel. I think Paul has raised a profoundly important issue, and he and I talked about this before. On the one hand, you don't have a system, and on the other hand, it's very hard to know how you make a system work, both substantively and politically. And I happen to agree with Paul. I think the provision, the support of the dollar in order to support exports by China, I think probably did play a real role in our crisis for the very reasons that Paul said. On the other hand, having said that, what do we learn from it? And I think we learned what Paul said, but the trouble is substantively and politically what you do about it. That's, I think, a very complicated question he's rightly raised. Okay, what was your question to me again?
my question is, if you look at the underlying...
Oh, yeah, what should we do?
Yeah.
Yeah. Well, all right, Paul raised the question of confidence in the United States, and I think that, I think you actually asked me to comment on two subjects, so
Yes.
I will do that, although you've forgotten one of them.
No, I didn't forget.
You didn't forget, you just didn't mention it, but I'll mention it. Okay. You know, one of them is our if we're going to if the global financial community is going to have confidence in the United States, then they also have to have confidence that we have a sound fiscal system. And it is true that deficits have come down a lot lately for all kinds of reasons. Partly, I think they have to do with a sequester, which, in my opinion, is too onerous to stick. Partly, it's change in healthcare costs, which is good. But fundamentally, we haven't even addressed it anyway. The structural issues in our fiscal situation. And while the projected deficits, as we all know, for the next few years look at least acceptable, although the debt-to-GDP ratio is way behind. So in the low 70s, it was about 40 before the crisis, so it's way up from where it was. But even if you view this as acceptable for the next few years, there's no room to have something go wrong, because then you'd ratchet up. But much more importantly, as you look out over time, the deficits start to go up again. And I think it's fair to say that both in the business community in the United States and around the world, there's a serious concern about our long-term fiscal trajectory. So on Paul's point, if we're going to have confidence in our economy, confidence in our currency, I think we must address the structural deficits or the structural causes of our long-term deficits. The question, how do you do it? Because we also have a situation right now, we have very high unemployment. The labor market is actually much worse than the unemployment picture because of discouraged workers. We've had significant hardship experienced by a lot of Americans for a long time. And I think the way to reconcile those two is to put in place a fiscal program, and I think substantively this is right. The politics of it in a dysfunctional political situation right now would seem to be impossible. But to put in place a fiscal program, we enact fiscal discipline now. You defer the implementation for some period of time, and I do think, Jeff, there are ways to do that with points of order in the Senate where it actually would be enforceable. Excuse me. You have funding through the beginnings of entitlement reform, which is what President Obama has already proposed. It's changed CPI and Medicare means testing. You have robust public investment. You reduce the pressure on discretionary spending by virtue of having begun the process of entitlement reform. And then within that context, you would have room, since you put in place, at least in my hypothesis, a context of fiscal discipline, you would have room for a reasonable stimulus. And that is, in my judgment, what we should do, and I think it would help meet the problem that Paul has raised, which is this question of will we have confidence in our economic situation, which I think very much goes to the question we have confidence in our fiscal program. And I emphasize, by the way, in that context, because you've now created room, you could also do the public investment, infrastructure-based research, and the rest that you need. Okay. The question that you didn't include in your question just now, but what you asked me is, should we care from an economic point of view about social conditions in the United States? And I think the answer is absolutely yes. We have, as I mentioned before, very weak labor market conditions. We've had stagnant median real wages for a long, long time. In fact, for decades, except for the last half of the 90s when we had tight labor markets. And we have a very serious income inequality problem, as Roger and I were just talking about. Poverty rate is starting to go back up again. And these are clearly moral and social issues, but I think they are major economic issues. Three reasons. One, if an economy has increasing median real wages, then the workers have the resources to obtain nutrition and health care and, education, the rest that enables people to be successful economically, but also increases productivity and increases demand. And then I think there's the point that if you're going to have support for trade liberalization, market-based economics, flexible labor capital markets, and so forth, the predominance of your people have to believe these policies are working for them. Make one other comment, if I may, and I'll be finished, yeah. The United States has enormous strengths. We should succeed over the long run, and I think in the context of what Paul said, I think we should be an economy in whose currency people will have confidence. But the trouble is, in order to do that, we have got to have effective public policy, at least in my judgment, on fiscal matters, public investment, reform in all kinds of areas. We also have to have strong regulatory protection, as this recent crisis is so strongly manifested. The system had far worse downside than virtually anybody saw. And clearly the lesson to be learned from that is we need reform. We need to have strong regulatory protection against systemic risk. We need to have strong regulatory protection for consumers. These issues are very complicated. What effects various proposals and enacted measures will have, it seems to me, are still very uncertain and very unclear. So I think when it comes down to it, that the ultimate protection for us in terms of regulatory matters, and Sheila knows a lot more about this than I do, but this would be my view at least, are strong capital requirements and strong leverage requirements. Finally, one final comment. I do think, and I guess Gary's going to comment on this, we live in a global economy, as Paul said, global financial system, and we need to have effective international coordination in all kinds of areas, financial, but also climate change and a lot else. At the very time that we need that, my impression at least is the will for international coordination and the institutions that represent international coordination, like the World Bank that Bob used to run, are weakening, not strengthening. That's my comments.
Great.
Okay.
Terrific.
That's why
Yes,
we
Sheila.
don't have a monetary system.
Can you give that to Sheila?
That's why we don't have, well, no, we may, well, okay, well, a lot of issues there. Okay.
I agree with you.
Sheila, I think there's an underlying theme here that the system is somewhat precarious. And if we just go back to the 2008, 2009 crisis, the system almost collapsed. So there's a lot of discussion about systemic risk. Could you just give us a way to think about systemic risk? What is it? What's been done since the crisis that actually addresses it? And in your view, what would be the future regulatory agenda to actually strengthen protections against systemic risk? And I know it's a really big question. If you can do it in 4.5 minutes, that would be wonderful.
Well, at the heart of pretty much all financial crises we've had, particularly those driven by asset bubbles, the core problem is leverage, excessive use of leverage. And that's why you see such broad-based support for very toughening significantly the capital requirements and leverage constraints, especially on large financial institutions. So you have people like Bob Rubin and Alan Greenspan, you have the New York Times, you have the Wall Street Journal editorial board. It is widely accepted that to have a more stable system, more resilient system, so when unexpected losses occur, and they will always occur, you've got some loss absorbency. And so it has been somewhat frustrating that it has taken us so long to get the capital rules changed and capital raised significantly. We have done a lot through the stress testing, but the rules very much are still a work in progress. The Systemic Risk Council, which I chair, has taken a very strong position on increasing capital requirements and constraints on leverage. Still, there's international pressure. The U.S. regulators have moved ahead with tougher rules than those that were internationally agreed to, appropriately so in my view. But there's still relentless industry pressure against it, and even international regulators are trying to pressure our own regulators to back down. So I hope they don't, because if there's one thing we can do to increase the resiliency of the system, make it more able to absorb the next shock when it comes, it is to get those capital levels up. Reduced reliance on short-term funding, too, was a huge problem in 2008. The market itself has driven a lot of progress there. So there's still too much reliance on very short-term financing, particularly repo financing. So you're going to the market every day to fund yourself, and that doesn't work so well when markets freeze up and nobody wants to lend you anymore. There's been some progress there. On derivatives, which were highly opaque. We just didn't know where the risk, we found out it was with AIG, but we didn't know where the risk with the CDS market in particular was during the crisis. We were flying blind thanks to Gary Gensler. We have a much more resilient, a better supervised market for derivatives that used to be traded off exchange on a bilateral basis. Was about 2/3 of credit default swaps under the indexes under your jurisdiction are now in centralized clearing, about 70% of interest rate swaps. It's amazing what he's accomplished at the CFTC. So he had more work to be done there, but that makes our system much more resilient. We have prophylactic measures now, too, with the Volcker rule at last being finalized to make sure that they don't do dumb things to begin with, that generate the losses. And we have mortgage lending standards as well, which we didn't have. So basic. We just didn't have them prior to the crisis. We have them now. So those are all very positive things that have made our system work better. There's still a lot that hasn't been done. I would say about 60% of what we know needs to be done as a result of 2008 still hasn't been finished. Money market fund reform isn't there yet. Again, as I said, there's still too much leverage in the system, that we've made some progress. We really have done nothing to reform the securitization market, in my view, which I think is very unfortunate. And notwithstanding the Herculean efforts of Gary and his team at the CFTC to get the lion's share of derivatives, at least in CDS, index CDS, and the interest rate swaps into centralized clearing, Congress will not give them the budget to regulate those clearinghouses. I was the chairman of the CFTC in 1993. We had 15 fewer employees in 1993 than Gary did when he just stepped down. It's amazing that they have not grown the agency to keep pace with these huge changes in the derivatives market. So that is something Congress needs to fix. It's been another priority issue for us. In terms of future risk, my main concern is that, getting more to Paul and Bob's comments, we're still looking in the rearview mirror. We're still trying to fix what we knew what went on in 2008. We're not looking ahead to future risk. If you believe, as I do, and I think people like Steve Roach and others have said that monetary policy did whatever the best intentions are and whatever was driving it, the interest rate environment prior to the crisis, I do believe was a contributor. Investors were looking for yield, and they weren't doing as much due diligence as they should, buying all those subprime mortgage-backed securities, and it really wasn't hard to find out just how badly underwritten those mortgages were if you looked. But you had investors searching for yield, and I do think that drove part of the problems. And now, monetary policy now for 5 years has been far more accommodative than what we saw prior to the crisis, and it's been done with the best of intentions, and it's been done by the Fed. They feel helpless. I don't blame them. We're not getting any fiscal leadership. But you keep interest rates this low, it encourages people to borrow. It encourages leverage. And it encourages those normally risk-averse investors like pension funds and insurance companies to go farther out on the yield curve because they can't buy treasuries anymore. They're not even keeping pace with inflation if they can buy them. The Fed's been buying 90% of net new issuance, so that's going to be ratcheted back a bit. So I do worry that excesses may be building, and I know the Fed's trying very hard with the other regulators to use macroprudential tools to address those risks. But I do think this is a very real concern, and we're not looking forward enough in terms of how to deal with the next shock. We're still trying to fix 2008.
Thank you. Roger, one of the issues that has gotten a lot of attention since the financial crisis is the issue of too big to fail. And there are a number of proponents of taking the really big banks and breaking them up. This is obviously an issue that people are looking at with a lot of emotion, and also there's been a lot of analysis. Could you frame this for us? How should we think about that? And what angle do you think is worth contemplating in the too big to fail arena?
I'll be happy to do that, but I must say at the outset, having taught at this school about 30 years ago and looking around at this amazing building, I obviously taught in the BC period because you're now way into AD. Well, this is such a ubiquitous term, too big to fail, that I'd like to start by defining it or trying to. When one hears these four words, the reference usually means, at least in my view, that the United States continues to have financial institutions, banks particularly, but perhaps other financial institutions, which are so large and systemically important that should they get to the edge of insolvency, they could not be allowed actually to become insolvent and to go through a traditional bankruptcy process like an industrial corporation would, Chapter 11 and so forth, because the systemic implications would be too adverse. And that the federal taxpayers, as we saw in 2008, would have to step in and be part of a rescue of such institutions to prevent their failure. And one hears a great deal of commentary in the press and elsewhere in forums like this to the effect, or asking the question, as to whether or not the Dodd-Frank legislation and the work of the regulators since 2008, including, I might say, Sheila and Gary, has or hasn't been successful in ending this condition of too big to fail. Now, I want to emphasize that I'm not personally associated with any of the largest financial institutions, and I don't have any dog in this fight. But my own view is that the legislation and the quite heroic effort of the regulators has been extraordinary towards reducing the risk that any of the largest institutions in this country actually would fail. In fact, I think that the United States banking system has been quite brilliantly recapitalized and restructured under the leadership of people like Sheila and Gary, and that the system is in a safer condition today than it's been in many, many years in terms of its capital, its liquidity, its transparency, and so forth. And I think the regulators deserve a tremendous amount of credit for that. At the same time, the theory of too big to fail has, in my view, not changed. In other words, in the unlikely event, at least unlikely over the foreseeable future, that one of these institutions would actually get to the edge of the cliff, especially in crisis-ridden capital market conditions, I don't think that that we'd see an outcome other than the regulators again organizing a rescue. But that is not a new theory in America or a new reality, not at all. I recall vividly in 1985 that the Continental Illinois Bank was rescued. That was, for all practical purposes, 30 years ago. A short time later, the Federal Reserve organized a rescue of long-term capital management. The hedge fund, albeit not with public funds, but the Federal Reserve orchestrated the rescue. And so we've been living with this reality for a long time, and other advanced nations too. Now, this gets to the question, related question, of size, and whether the largest institutions in this country, and the big four banks, are total assets are 40% larger than they were in 2008. And whether or not a goal of regulatory policy should be, or whether it actually is today, increasing capital ratios further and otherwise pressuring these institutions to downsize. I think that's one of the great big regulatory questions on the table right now. I think Gary and Sheila could speak to this better than I can, but I believe this is under very active discussion among the regulators, at least in the Federal Reserve, and that, at least at the margin, yes, they would like to see these institutions smaller. Whether that's achievable, I think remains an open question. The way one might do that is to increase further capital requirements and in ways which make certain businesses these institutions are in just unattractive for them to continue to be in terms of returns and margins and so forth, and therefore have them progressively get out of those lines of business and thus get smaller. Now, the counter-argument, of course, is really a global competitiveness argument, namely that it's to the advantage of the United States to have institutions of this size from the point of view of the functions of our capital markets and the intermediation functions that these institutions play, or disintermediation functions, and that to make them materially smaller would be competitively disadvantageous to the United States. That's the debate. I don't know how this is going to play out. It'd be interesting for us to discuss that a bit, but I think that's one context for too big to fail.
Gary, Bob mentioned the importance of global coordination, and I know Paul spent a lifetime talking about that and pushing for it. You have just come off a very, very intensive period of public service where attempting to coordinate international financial policy has been a large part of your remit and a large part of your efforts. How should we try to come to grips with the challenges of global coordination in the regulatory arena, given that we're in a global market and also given that it's sovereign countries with very sovereign impulses. What is your view on this whole thing?
First, thank you, Jeff. It's an honor to be here at Yale. It's an honor to be with so many former colleagues, friends, and this is 1 week out for me. To be on this panel of formers is really a high honor. It's also an honor to have my youngest daughter with me, who said, well, Daddy, if you're going to Yale, why don't we start our college visits together? So, Isabel, it doesn't get better than visiting Yale for your first college visit in a building like this, my God. But you asked me to address the challenges of global financial regulation, and all within 4 minutes. Let me start with the context of four quick observations. First, since antiquity, we've lived in a multicultural, multi-jurisdictional world. Anybody just knows Genesis? Go back to the story of the Tower of Babel. It was true when it was written. It's still there today. It's a reason why it was written in Genesis. Second, capital and risk knows no geographic border. None. This is true system-wide. This was true when the Latin America crisis hit us in the U.S. in the 70s, when the Asian and Russian debt crisis that Bob helped manage through for the U.S. hit us, and I would contend it was true when our housing bubble hit the rest of the world. So it's not just that others hit us, we hit them. But it's also true institution by institution. You see, the nature of modern finance is if one affiliate goes, that short-term funding that Sheila talked about, the whole institution goes. AIG, of course, we talk about here in the U.S., it was run out of London. It was a French bank with a London branch, but it was our $180 billion that went into AIG because it was our institution ultimately. And I remember when Bob called me up, the Treasury Secretary at the time called me up, and Isabel was just a 2-year-old on my lap. True story. And Bob says, Gary, it's a Saturday. Would you mind tomorrow going to long-term capital management? And he asked me to go up there. And I remember the phone call as I went back to the airport in Greenwich saying, it's going to go down by Wednesday, Bob. And it's got a $1 trillion derivative book, and this is this and this and this. And he said, well, what's going to happen? I said, Bob, I can't tell you. He didn't like that answer. But it was true. I couldn't tell him. But I raised something else. I said, Bob, there's one more feature to it. Long-term capital management booked their entire $1 trillion derivatives book in the Cayman Islands. And I said, I don't know Cayman Island law, and I don't think anybody at the Treasury does. Bob says, I see we have a problem. Right? Houston, we have a problem. Third, finance thrives on arbitrage. This is what Bob Rubin did so well when he was at Goldman Sachs. But we should accept it and recognize that it thrives on arbitrage. What is that? That word means the profiting between the differences between two markets. For centuries, that was about the difference between the price of oil or wheat or corn between two markets. That's arbitrage or risk arbitrage. But it also means, past that classic difference, modern finance is about trying to find differences in tax regimes, regulatory regimes, capital regimes. We just have to recognize that's a fact. And then fourth, I would say nations often regard their financial services industries as a source of pride, of jobs, of tax revenues. They compete for financial centers somewhat like competing for champion sports teams. And that's just the nature of what we have. So these basic realities cause attention. There's the goals espoused for a level global playing field, harmonized rules. 180 nations should have the same thing. But there's a divergence of political and cultural backgrounds. We've got the natural tendency towards financial center competition, financial arbitrage. So what do we do recognizing that? We know it's true. We can't get away from that imbalance. I think first, global financial regulation is more of a continuing journey than a specific destination. Bob tried to do a lot in the 90s. We did our share now. Paul probably did it earlier. Bob did it in his time. It's a journey. Two, I think we use international forums and standard-setting bodies. The Financial Stability Board, something that Mario Draghi got more connected to the political leadership, was a really good thing to get it more in tune with the political leadership. And I think that the various standard-setting bodies are critical. Third, I think we really need to continuously measure against these international statements and pronouncements, because when there's a statement, it's ultimately just a political statement, and then you've got to sort of move that inventory through the system to actually change things. So it's periodic reviews. Fourth, I think the key drivers have to ultimately be the US, Europe, and Japan. It's not to say that China and other countries aren't going to be a critical piece. In the derivatives world that we did, 90 to 95% of the transactions are Europe, the US, and Japan. And if you don't have a consensus there, you're not going to bring others along. It doesn't mean other countries aren't important. Fifth, I think that it's critical that we cover the worldwide operations of financial institutions, not just take a territorial approach. When Bob made that fateful call to me 15, 16 years ago about long-term capital management, we couldn't say, well, if it's in the Cayman Islands, we're not going to worry about it. And certainly, when Sheila and Tim Geithner and Hank Pawson had to sort through AIG, they couldn't say, oh, it's in London, we don't have to worry about it. And so we can't take a territorial approach. On the other hand, we have to actually recognize if the Europeans or Japanese or somebody in Canada has a good regulatory regime, we recognize it and we stand back, and that's called substituted compliance or equivalence, and we have a way to stand down and let them do their thing. Look, progress will ebb and flow in cycles, generally around crises. There's going to be a crisis like the Latin America crises or the Russian debt crises or this 2008 crisis. We'll make forward motion, but reality is it will ebb and flow, and sometimes it will go backwards. But there has been real progress on capital reform, on accounting reform, hopefully on what we did in derivatives, the resolution regimes that Sheila and others at the FDIC put in place. On LIBOR, at the center of the crisis, we had an interest rate that was being rigged, and now we're actually working globally to fix that. So there's real progress, but I think just like the Tower of Babel, we live in a multicultural world which we have to recognize and do our best around it.
So, Bob, you know, your last...
I'm not leaving.
No, go ahead. Your last position, government position, or public service position, head of the World Bank, you probably more than any of us had real in-depth experience in dealing with emerging market nations. And I don't think any preliminary discussion of the global financial system is complete without talking about the new players and the influence that they may have and the challenges that they could pose. And you know, what framework should we use to think about that? Paul, I believe, rightfully said that the U.S. is still at the center. There's a lot of debate as to whether or not this power is waning, this influence is waning. But there's no debate, it seems to me, about the rising tide of other nations. So give us a sense of what the key issues are here.
Well, I think the first framework I'd use would be based on what her father said. I would suggest that Isabel want to visit a university in the Cayman Islands. Might be good for her to try to do this in the near future. Like Gary, I want to thank you and Yale for the invitation, and this is a wonderful facility. But I also want to say for the students here, having talked a little bit about with Jeff and what he tries to teach, it's a compliment to you, but also the university, that you have that type of multidisciplinary program, because as someone who's tried to keep some ties with the academic world, it's actually quite frustrating as a policymaker how difficult it is to get useful input from the academic community that has diverged further and further from at least the challenges that policymakers face. I'd like to answer your question with sort of 5 thoughts. The first, which is you started with, but I just want to keep bringing us back to, is that, you know, in ever considering financial systems, it's important to keep in mind that their fundamental purpose is to relate to people and the real economy. That's what they're there to serve. And second, as part of that, you know, I think that we're in the midst of a very big structural shift in the real economy, with the clear direction being the increased role of developing economies. Now, there's a bit of a recent stumble that's sort of taken people's attention a little bit away from this. But if you focus on the real economy side, in the past 5 years, 2/3 of global growth came from developing countries. As recently as the 90s, when Bob was secretary, that would have been under a quarter. In the past 10 years, exports from developed countries to developing countries increased from about 25% of their total to about 50% of their total. The McKinsey Global Institute has done an estimate that there's now about 2 billion people in the world earning between $3,000 and $20,000 a year, representing $12 trillion of purchasing power. Now, all of these changes have ripple effects: agriculture, urbanization. So China is urbanizing at 100 times the scope and 10 times the pace of the first mover, Great Britain, in the process. So in understanding finance, you have to figure out how these underlying shifts in the real economy are going to affect things. And that leads to the third point. So far, there's been important financial market development in developing countries, but there's still a huge way to go. And so this relates to issues such as mobilizing savings for productive investment. It deals with risk management insurance. It deals with aging workforces and pensions. And it's interesting, over the past 10 years, what you've seen in developing and add transition economies out of the ones from the former Eastern Bloc is their share of equity market capitalization has tripled, but it's still only 30% of the total. Their share of bond markets have doubled, and it's only 20% of the total. And there's a critical issue, if you're thinking about finance, which is basic financial inclusion. There's about 3/4 of the world's poor, about 2.5 billion people, that don't have access to any financial account, insurance, risk management, currency transfer, and women are the predominantly on the weaker end of that number. So fourth, and starting to connect this to the challenges that this generation of students will have, I think this global structural shift in the real economy and the financial implications from that is going to have a big effect on the interaction of financial systems between developed and developing countries. So if you look at some of the people on this panel, they've lived through this. You started this with the debt crisis of the 80s and 90s, and, as Paul and others were alluding to, some of the ramifications of that in terms of building reserves and exchange rate policies. We certainly saw this in the Great Recession and the huge, in some ways, unanticipated effects of the policy responses on trade finance, and, of course, the early effects of QE on some of the developing countries. Interestingly, the QE1 had a different effect than QE2, depending on market responses. And now you're seeing it in the effect of tapering, particularly on countries like Brazil and Turkey and India and Indonesia that have sort of bigger current accounts. And the big one that is sort of looming there is that, as you start to get sort of deeper bond and capital market integration with China, you've got to expect that Chinese interest rates over time will have more of a correlation with global interest rates, and that's going to change the function. So finally, and this kind of comes back to one of the points that Paul introduced, we sort of have a circle here, is that I think over time, one of the policy challenges for your students will be to manage a move to a multipolar reserve currency system. It's interesting, Paul referred to system. Keep in mind, the gold standard was never a treaty. It was an agreement, an accepted series of norms and practices that people had. And I think what we're likely to see is a dollar, euro-based system, maybe even over the course of the next decade, a key role of the renminbi in this process. And this is going to have very significant effects. It's going to have effects on the competitive discipline, going back to some of the things that Bob Rubin had. The exorbitant privilege the United States had may not be the same that it was in the past. It's going to have effect on crises. It's given the United States an incredible resource that even in the worst of circumstances, people retreat to the dollar. Well, what if that is no longer part of the system? And it also runs some risks, going back to what Paul touched on creating either some potential dangers or cooperation on issues of exchange rates and other policies. So when I pull this together, I guess my point is, even as you're considering the particulars of banking or securities or regulatory issues, it's very important to keep in mind not only the global effects, as Gary mentioned, but some of these structural shifts that we're seeing in the global economy. And I'd be willing to wager for your students, those will be as critical policy issues as what some of us on this table worked on G7 dimensions.
Well, we've raised a lot of issues, and I'm going to just raise a couple more and just ask one or two of you to comment on them, and then we'll open it up. Obviously, the whole issue of regulation looms very large, always has, but particularly after the financial crisis, 2008 and 2009. I'd like to pose the question about the political environment for regulation if we were to look, let's say, over the next 5 years. I'd like to start looking ahead a little bit. And Sheila, maybe I'll ask you to start. Just from sort of policy and politics point of view, how do you see the environment for some of the things that you were talking about that have yet to be done? And then I'll ask Gary to comment maybe a little bit on the global aspect of that.
So I think it continues to be a struggle, and there's just relentless lobbying against some of the more obviously needed reforms, which is one of the reasons why it's taken so long. And you can get it done. If you have determined leadership, as we had at the CFTC, it can get done. But it takes force of will. It requires political support from the Treasury and the President for the regulators. It requires the Hill to stand down and let the regulators do their job. And frankly, that doesn't happen unless we engage more on a grassroots level. That it becomes more of an issue for a stable financial system. It's one of the reasons I wrote my book, and I think people have become cynical. I think the bailouts, look, a lot of what we had to do, but it created enormous public cynicism and undermined confidence in government as well as the regulatory process, and we need to turn that around so that people understand this can get fixed, but they need to weigh in and support it because there are a lot of vested interests that will resist it. You know, I'd like to see more industry, good players in the industry weigh in on this. You know, I've never understood, thank you, Bob, for giving a nod to tougher capital levels. Why don't bond investors weigh in? You know, that capital cushion protects them. You don't hear a peep from them. You know, some of the people in the industry need to weigh in as well. It's a lot easier to get it done if they speak up. So I think the political environment would be very, very tough unless those who have a vested interest in a stable financial system start saying more about it.
Yeah, please.
You know, it's interesting, Sheila. I can remember when I was senior partner at Goldman Sachs for a little while, and it was about 75 years ago, actually, right, Jerry?
Bob, they were all good years.
They were not bad years. But Sheila, you know, it was interesting. I was very troubled. I wrote about this in my book, which is still available in paperback. But I was very troubled about what? It's widely available. It's just the availability isn't taken advantage of. That's the problem. But Sheila, I was very troubled. I was very troubled about derivatives. So what I tried to do was to get industry-wide support for increasing capital margin requirements, because I think what Gary's done is very good and everything else, but I do think capital margin requirements are the ultimate. What happened, Sheila, was that I was told that if I continued to try to create that movement, that on the Chicago Board of Trade, where we were very active, that they would stop doing our business. So it's very hard to do these things. And I said, well, it's in your self-interest, because if we have these problems and then they undermine our institutions, then we're all going to pay a terrible price. But it's very hard to have people take an enlightened self-interest. It just doesn't seem to be in the nature of things, whatever set of reason. I'm not saying this won't happen going forward. I'm not being, but just a past observation.
Gary, to take a global perspective on the environment.
I think that...
I'm the oldest guy up here.
You are?
Yes. When I was chairman of the Federal Reserve, Bob Rubin was a boy at Goldman Sachs.
Supposed to do with that jab. Yeah, I know. Look, I think you can get things done. I think we have gotten things done, but it ebbs and flows. If Rahm Emanuel is quoted so often about a crisis, but I think it is the nature of things. I think there's some really hard consensus around capital that has been met, that Dan Tarullo and his leadership and Ben and now Janet at the Federal Reserve will be leading. But then it's hard. You start with a political consensus and you move all the way down to the granular, small, little details. And the devil is in the detail because back to a basic tenet of finance, there's arbitrage. When Lehman Brothers failed, they had 3,300 legal entities. And modern finance is all the large financial institutions have between 2,000 and 4,000 legal entities. So they will use structure to find a small, imperceptible arbitrage, difference in markets around some regulation. But I think we can get things done. It will ebb and flow. If the European debt crisis gets worse at some point, there'll be movement towards something. If it goes back, we even saw this in the last few years. It was actually small in relation to the institution, a $6 billion loss at J.P. Morgan over credit derivatives in their London office. But that sort of created actually some political openness to complete a Volcker rule. So it sometimes ebbs and flows.
Roger.
Let me just pick up on this and ask Sheila or Gary or anyone else on the panel to comment on this point. Sheila, you said that, or you bemoaned a bit the degree to which regulatory progress has been so slow. To what degree does that reflect complexity amongst regulators? At the time of the Dodd-Frank legislation began to be considered, there was a lot of debate about whether we should streamline the regulatory framework and in effect reduce the number of regulators. So I'd be quite interested in your points of view about whether that would be a good thing to do and whether this slowness reflects that complexity or not.
So my sense is with some of the rules, definitely the Volcker rule, that was a huge problem. But it's not the only. Some of the rules that are not completed yet are just with one. They're individual agencies with sole authority who have not finished the rules. So I think you need leadership, tenacity, focus, and so I can't blame it all on regulatory complexity. But clearly we need fewer regulators. I'm opposed to a single regulator. I think there's just too much risk for capture with a single regulator. But I argue, and I know Paul's Alliance for Effective Government, the Volcker Alliance, is going to be talking more about this, but we need fewer regulators. We need to merge the SEC and CFTC. We'll have a stronger agency combined with self-funding. We need to, I think, get along just fine with 2 bank regulators, not 3. I'm not sure you need much more than that. You need the Consumer Bureau. And so it could be, we could get along with a lot fewer regulators. It would be simpler, but it's hard to get good government things like that done. There's really no vested, there we go, the lobbying, the constituency. Everybody likes their own little regulator that they can talk with, and they don't want to deal with anybody else.
Bob.
Let me just add one other perspective to this, and again, linking it to an academic environment. I really urge people to teach economic history, because a lot of the things that happened in the past, people weren't stupid, and they weren't all venal. There's one of the lessons about regulatory experience in crises. I don't have the same scope as Paul, but I dealt with S&Ls, commercial banks, LDC debt, and this crisis. And over the years, as I've watched the fixes, I've learned that one has to be careful about unanticipated consequences. And if there's any lesson that I would draw, it's to sort of build in flexibility into the system to deal with that. And let me give you a very practical example that dealt with Sheila. When I was president of the World Bank, many people don't really know how the finances work. It's a very complex financial institution. And in the height of the crisis, we were AAA credit. I'd be meeting with my financial team every morning and every evening to try to think, what have we not thought about? And when you have a very good team like that, they're going to think about the standard things. So it was my job to try to come out of the left or right field. And one day, I don't know why, I said, do we have any deposits? You don't normally think of the World Bank having deposits. And they said, well, yeah, actually, as part of our liquidity flow, we have about $1 billion in Wachovia Bank. And I recalled, because of FIREA, which was the legislation that was fixed one of the last times in government, that based on those crises of the 80s, that the Congress in its wisdom said, well, when we resolve institutions, you either pay off depositors unless the FDIC declares something to be a systemically important bank. So I asked my team, has the FDIC declared Wachovia to be a systemically important bank? And they said no. So I called Hank Paulson, and I said, Hank, you know, I can't walk away with $250,000 of FDIC insurance. You know, I have a fiduciary responsibility. So and then I think after a couple days, you did declare it a systemically important bank, but I had to pull $1 billion of deposits out of Wachovia Bank because that was my fiduciary responsibility. Now, I happen to remember that because of my experience in the 80s in the FIREA, but is that really what Congress had wanted in terms of stability? And one thing I will assure the people in this room, that 10 or 20 years from now, there will be some crisis, the way markets go up and down and the way that people fail to learn from experience, and there'll be some wonderful fix that somebody put in this time period that will blow up. So the best that I can offer is feedback loops, keep learning from experience, and build in flexibility.
Okay, let me pose one other question before we go to a question. This has to do with the next financial crisis. I think most people in the financial arena would say that is built into the system is recurrent crises. How severe, how long between them, we don't know. I'm going to ask Roger maybe to, in your view, what's your nightmare scenario? Where could the next crisis come from? And by the way, nobody can leave here to go to their brokers. Okay.
I think the first point, Jeff, is to reinforce and perhaps elaborate a moment on the point you did make, which is if you look back on recent decades in terms of financial crisis, what do you see? You see increased frequency of serious crisis, and I think you see increased magnitude of such crises. So the question is not when, but the question is not if, but when. And I think this greater and greater frequency reflects lots of factors, but one of them is the velocity of capital flows and the globalization of capital flows. And so the chances are it's going to come sooner rather than later. I remember vividly when Bob became Secretary of the Treasury and I was in the Treasury, and I said to him, it's just a question of when you have a crisis on your watch, not if, and you should be thinking about that. And any Secretary of the Treasury who serves for any meaningful period of time, which is not every one of them, encounters a serious crisis. I don't know where the next one will come from, but I think it's likely to be soon in big historical terms, and I think it's likely to be serious. Now, of course, the great debate right this minute, and Sheila alluded to this, is whether quantitative easing and aggressive monetary policy is advancing the time of the next crisis to the degree that the cure is bringing on the next disease. I don't know whether we'll see that looking back historically or we won't, but that's a great debate right now in finance. Are we laying the seeds for the next bubble? Or are we seeing bubble-like conditions right now? If you turn on CNBC tomorrow morning or Monday morning or Tuesday morning or Wednesday morning, you'll hear someone come in and say, we're already in a bubble-like environment, whether it's certain real estate prices or other asset prices. So I can't say when the next crisis will come, where the next crisis will come from. I just don't know, although they typically come just where you're not looking, and typically they do not repeat themselves. You had a crisis in left field, so you're focused on fixing up left field, and it comes from, behind the catcher. Sooner rather than later, larger rather than smaller, and from an unexpected source.
Would you comment on that?
Well, I'm inclined to respond to the kind of question you posed with a very simple thought. Not in my lifetime.
Paul, we hope you a very long life. And so, look, I think, Jeff, the thing, I don't know where it will come from, but I agree with Roger, it will come. I think the key is that there's a freedom to fail, that the next Continental Illinois, which was in the 1980s, which some students weren't born yet, or the next AIG, is allowed to fail just like my dad's little business in Baltimore. If he didn't make payroll on a Friday, he'd fail. And so the challenge, because it's an enormous challenge, is in each country that the sovereign and the taxpayers aren't seen to bailing out. And I know when we were at Goldman Sachs, Bob, we never thought the government would bail us out in the 70s and 80s. It wasn't part of our thinking. Maybe you were more senior. I didn't. But in those days.
You know, Gary, look, all of us would like to have a world in which institutions are not too big, and I think it's even more, as Sheila said, not too interconnected. I think that's the real issue, too interconnected to fail. But my view is, with all the things that we've done, all the things we can do, we will have future crises. I have some personal opinions as to where they could possibly come from, but we'll see. I think we'll have
you care to just give us one hint?
No. And I'll give you actually one second. And I think we will use public money again, because all of us would like to have not institutions that are not too big and not too interconnected. But when you get to the point where we reached in the Mexican financial crisis in 95 and then in 98, 97, 98 with the Asian financial crisis, our choices were, do we engage with public money, or do we take the risk of dire contagion consequences? And I don't think we're going to be able to avoid that, Gary. I hope I'm wrong, but I don't think all the changes we've made are likely to have avoided that. Maybe I'm wrong. I hope I'm wrong.
Yeah, I think we're not all the way there yet, but I think it's got to always be our goal. And not just because it will make a better economy. I think the public will accept finance better. I think right now there's this tension that the public said, wait, why is it that my business shutters and
Gary, I think you're saying the obvious. But what I'm saying is, I agree with everything you've said. I just think the question is, in the real world,
can we get there?
Can we get there? That's all. And I'm skeptical, but maybe we will.
Well, I think I'm fairly positive about Dodd-Frank having the tools to end too big to fail, in the sense that taxpayer capital investments and subsidies will no longer be involved. And as for your $1 billion deposit in Wachovia, I think what we want is for uninsured depositors to monitor their banks and monitor their bank's health. And maybe when Wachovia bought Golden West, somebody should have come into you and said, gee, do we still really keep $1 billion into Wachovia? So we want market discipline by large depositors, and as painful as it would have been to put a haircut on the World Bank, smaller banks like NEMAC, I can tell you some real heartbreaking stories. The mother of an Afghan soldier who died and put the life insurance proceeds uninsured in that bank. A policewoman who had sold her house had uninsured proceeds in the banks. Why do they take losses as uninsured depositors and the World Bank doesn't? Because it's in something that, yes, we...
The key point is we didn't take the loss.
You did not take the loss.
The key point is we didn't take the loss, and the key point is you did determine it was systemically important.
We did. We absolutely
did. A few days
did.
late.
We absolutely did. That's actually, and we ended up not having to do that.
I'm not blaming you.
No,
I'm making the point that Bob Rubin made.
We made some very unpleasant decisions, but I'm just saying going forward, that's one of the reasons why we sought resolution authority. So we had the ability to deal with large banks in a way that were as similar to the way small banks are handled, that don't involve systemic disruptions. And I think for the larger institutions, the strategy now is to make sure there's a thick cushion, not just of capital, but unsecured debt as well that will be subordinate to your deposits, that will be there to protect those deposits. And that will also increase funding costs to create market pressure for these large institutions to downsize. So I actually do think there's a viable Dodd-Frank strategy to deal with the problem in a way that will at least make things a little more comparable and equal and fair between how large and small institutions are dealt with.
I just want to come back for a second to this
and then
point
I'm
about...
going to give Paul the last word before we...
Well, I'm going to do that. About sooner rather than later. Looking at Paul, just looking at him, and remembering that he was chairman of the board, chairman of the Federal Reserve in, I think it was 1870. If he wants to bet $10, to the effect that the next crisis is not in his lifetime, I'll take that, son. I'll take that.
Okay, you have the last word on this subject, and then we're going to open it up.
Well, I'll give it the last word on this subject. It's interesting these people are as concerned as there are, and I hope it's not in my lifetime, but I am reminded of 2 points that, the great guy Minsky, nobody ever heard of until we have these repetitive crises. He's an economist, and he pointed out you had a real systemic problem. When people felt good and you had a period of prosperity, people will take risks and extend themselves in a way that will bring about a crisis. It's an inevitable, repetitive kind of cycle, which I think is true. But let me relate this also to the international monetary system or the domestic monetary system in terms of discipline. You give people enough money, something bad will happen too easily. Karl Marx, just to go back to 1870, when I was a boy, he was not entirely wrong all the time. He said you give capitalists enough rope, they'll hang themselves. And there's some truth to that for individual capitalists and I think for the country as a whole.
There we get to your economic history. Okay, we'd love to have some questions, and I think the way we're going to do this, if you raise your hand, pardon me, I will point at you, and then somebody will bring the mic. Okay, yes.
So speaking of, you referred to the interconnectedness and the potential forthcoming crises that might afflict us. And I was wondering if you could comment specifically on the risk that China poses as a due to its lack of transparency and potential level of corruption. While I wait for the question, I'll just comment that Roger Altman was a fantastic professor 30 years ago when he was here.
Let's see. Would you like to? Okay, Bob, do you want to?
Well, I think you can see today there's two big things going on. One is the Chinese are in the midst of a big structural shift in their growth model. And the good news is they recognize the need to do it. The more not so good news is it's a very difficult job. And we've seen the importance of China to the world economy. But even within that, and this is where these ripple effects flow, the Chinese greatly expanded their credit as part of their stimulus program. And as they move to a more market-based financial system, as they're struggling to do, you can see the effects of that right now with the cities and some of the new there's an article in the Wall Street Journal about different bad debt regimes. So I think in the near term, China has enough resources, and it's actually got enough sort of non-market tools that it would probably be able to manage any of the major disruptions for now. But part of the point I was referencing is if the Chinese move in the direction they would like to move to get more open capital markets, greater efficiency for capital allocation, things that other East Asian economies have done, well then the interconnectedness point that Bob Rubin made will be in greater force. And so you'll have, I think one of the challenges in this, going back to Paul and Bob's comment about sort of norms or rules or acceptances, we actually did build some of these among the G7. There were certain set of practices, but you're going to have a whole new set of players now. And that process is very much in train. It's not that it can't happen. These things, people can see the combination of self-interest and systemic interest, but it's going to have some ups and downs in the process.
Rick, let's see, can you get a mic down?
On the eve of the last financial crisis, private sector debt to GDP was 310%, more than double any time ever before in the past at any other peak. Every single form of private sector debt, household mortgages, consumer credit card debt, non-financial business debt, and financial sector debt, all of them at least 50 to 100% higher than ever before in terms of ratio to GDP. So why aren't we thinking about regulating leverage more comprehensively? Why only bank capital requirements? What about mortgage, down payment requirements? What about credit card minimum payment requirements? What about collateral on derivatives? What about stock margin requirements, commodity and currency margin requirements? wouldn't a comprehensive program of leverage regulation make some sense? And not to say we go immediately to very high levels. You use it as a counter-cyclical tool in the future. It seems to me all of the complex stuff in Dodd-Frank sort of misses the main point, which is regulating leverage is something we need to do.
Bob, do you want to start that, and then I'll...
Yeah, I can answer in one sentence, Rick. I agree with you, and I think long ago, and I think I said this in response to Sheila something or other, but we should have had margin requirements on individuals using derivatives, for example. I think Canada, correct me if I'm wrong, but doesn't Canada have a down payment requirement with respect to...
Not sure.
I think so, with respect to... Yeah, they do. With respect to mortgages that we don't have. So I think you're right, but I think politically it's going to be very, very difficult to get there.
Sheila?
I agree, too. I think we subsidize it through the tax code. Sure, we subsidize the mortgage interest deduction, corporate debt. There's an increase of bias in favor of debt over equity because that's all deductible. So I think that there's some tools to the tax code, but you're right. We have been just struggling just to get bank holding company capital up when we really need to be looking across the financial sector. I worry about asset managers taking on more leverage. I mean, it's so hard to get return now. The way you do it, you borrow short, you invest long. And there's really not even any good data about others potentially using leverage as a way to generate heightened returns because it's so hard with the safe investments right now. So we need to look at it holistically. We absolutely do. And a lot of it can and should be done through the tax code. Whether we have the will to do tax reform and tackle this, I don't know. But I know some of the tax committees have been looking at it.
You know, Bob,
Okay.
sometimes it's lost in the narrative, but I remember in the late 90s, particularly around long-term capital management, that you were saying there should be margin on these derivatives.
Yeah. But the problem was, Gary, we also said that it was politically impossible to do anything, and it's the politics of all these things are very difficult.
Antoine?
I have not yet heard the word cyber risk from any of you. And if we're looking forward to risks, what do you think of the risk that a cyber attack could simply freeze the financial system for a while? And as you said, Jeff, it's the regulatory system. It's the oil that makes things going. How do you view that risk?
Anyone here want to comment on it?
As real. It's the nature of modern finance that we're so interconnected by the computer, and it's the nature of modern state warfare and terrorism that that's a tool of the trade if somebody seeks to use it. So our financial system has lots of protections. The question is whether there are enough. And it often comes down to the individual stock exchange, the individual clearinghouse, the individual financial institution that's got not dozens of probes a day, but thousands of probes a day into their systems. So it's a real risk.
Yes. Hold on one second.
I'm Rakesh Mohan, former Deputy Governor of the Reserve Bank and now the IMF. I wanted to go back to the first question that Paul Volcker was addressing, and I guess he didn't complete his thought on the future of the non-system. As he said, we have moved from the gold standard then to the Bretton Woods system and then to the current floating system. My question in a sense is that a lot of our theory to do with floating exchange rates really has to do with the current account movements, when in fact, and all our understanding of comparative advantage, etc., is really based on the current account. And what's happened in the last 20 years is huge and increasing movements of capital, and in both magnitude and volatility. And so it's not clear that the exchange rate movements do much adjustment. And so the question is, what really is the future on this issue of floating exchange rate international monetary system? And one of the proposals which came in a Brookings study a couple of years ago from Barry Eichengreen and others was to do with some kind of a system for cooperation between central banks. Is that a possibility, or what do we do?
Well, wish I
You
knew
can't
what
answer with one word.
I don't know. That's 3 words. But this is, you know, a description of the difficulties that you have. The question is, can you have enough rules, enough sense of cooperation between independent countries and between central banks and financial ministries and all the rest, that a real effort to diminish the risk of really big swings in exchange rates would in turn tend to stabilize destabilizing capital flows. If people knew that there was a limit as to what they could gain from purely more speculative activity, and you could absorb the more clearly trade-related activities. But then it comes down to multiple currencies. What kind of an agreement do you have among central banks? Are they willing to intervene in massive amounts? But beyond that, are they willing to undertake domestic policy measures that may be necessary to stabilize their own economy in a way consistent with a stable international system? And for all the reasons that you've heard talked about here, it's very difficult to get all these different countries to agree. When you don't have, you know, if I may just belabor the point a little bit more, I am been around for a while. And the position of the United States in the world after World War II, which was overwhelming, it was more than half the economy, all the finance, but that remained true in a position of really dominant leadership into the 1960s, certainly. And you had some possibility of getting agreements in some logical system when you had a clear leader for the world. That didn't exist anymore. I mean, we're still bigger than anybody else. We're still more important than anybody else. But nobody else is saluting when we come into the room automatically the way they used to when I was in the Treasury in the 1960s. Didn't matter who else was in the room. They all waited for the United States. Now they're willing to go off in one of these discussion rooms here, yeah, one of these little things, and make up their own system. So it's a lot more difficult now. But I don't think we can ignore the problem.
I just want to follow up on this for a second, because I think it's a key point. A lot of people have talked about the role of the U.S. in a situation, a multipolar situation, which Bob was alluding to, where the dollar is still the principal currency, but there are other currencies, and equally significant, there are other governments that have their own views and are expressing them. What is the imperative for U.S. financial diplomacy? What do we have to change? I mean, other than bemoaning the situation and other than describing it, what does it mean?
Well, I think you try as hard as you can to do what Bob and others were talking about, to have a domestic system, an domestic financial system that people respect and say that's a model and a system that is compatible with our own needs. And you can then build on that and see whether you can get some agreement much looser than we dreamed about in Bretton Woods, and certainly much looser than the gold standard, but nonetheless has enough discipline in it that people will respect. And I don't know, let me give you a little anecdote. I remember years ago I was in discussions on reforming the international monetary system, not a new subject, after the breakdown of Bretton Woods, and I was sitting alongside one of these interminable meetings with my French counterpart. And it's important, there was a Frenchman. They were not necessarily all that cooperative with what the United States wanted to do. And he drew a little triangle. He said there are 3 ways of organizing this system. We can have a bunch of individual countries. Result will be chaos. You can have a dominant country. If it's a tyrant, we got hell. We got a dominant country and he's benign, that's the only decent system you can have. And he was really talking about the United States. But we don't have that triangle anymore. What do we do?
Just real briefly, it starts with the point that Bob and Paul have made, that more the U.S. gets its own house in order, the more leverage and stand. In the United States, let's not overwrite this here. The United States still has a heck of a lot of influence in the system. Let me give you 2 practical examples to deal with this issue. One is during the crisis, the Fed extended swap lines to major economies. because in the monetary system there was a shortage of dollars. Why was there a shortage of dollars? Because dollars were still the one most secure currency. If you noticed recently, the Fed just made those swap lines permanent. That's a very sound thing because it means that markets don't have to worry about access to dollars in those economies. Now, we have some other economies, emerging market economies. The Fed may not be able to, the Fed had temporary swap lines with some of those. It did not make those permanent, presumably because it's not fully aware of the credit. But these are sort of what I'll call accumulating incrementalisms that can add different stability. Or a second example, the G7 countries really did reach a norm in political science terms, not a rule, that they don't intervene in each other's currencies unless they all agree. And I was at a G7 finance ministers meeting after the Japanese had sort of violated this, and there was a full discussion which the Japanese acknowledged. And I believe that will be the practice among those economies. That's not the norm among the major emerging market economies. And so one of the challenges over time will be what other combinations, including perhaps acceptance of some short-term capital interventions, if you have quantitative easing policies in the United States and others. But this is, thinking about this in an academic context, we're not going to have another Bretton Woods. And actually, if you go back and look at the historical research on Bretton Woods, it actually didn't do what it was supposed to do in the 50s anyway. That's why you had to have the Marshall Plan. But I do expect what you're going to see is incrementalism, and the real question is, will the United States still be the catalyst in that? Because really, there's nobody else that can do that.
Jeff, I would just add, I think that all of the people that have our jobs in the future, it's going to be more about consensus than it was when Paul was at the Treasury in the 1960s, and we were, obviously, all of us had to find consensus too. A little agency like the CFTC, I spent an awful lot of time around the globe. And so Europe really being sort of the UK, France, and Germany, and Brussels, so there's a multi-centered Europe too. The US, Japan comes together, whether it's through swap lines for monetary policy or regulatory policy or capital, that consensus can really move things. It's not the US alone, but it's finding consensus amongst 4 or 5 jurisdictions now. But I think it's doable.
Okay, we have time for, oh yes, sir.
Just a lot of you had mentioned grassroots efforts, and given that many of you are retired and you're writing books, I take it that's one of the reasons you're doing it. We have Bob from the Peterson Institute, which has probably spent more than anyone on the planet in the history of mankind on the dangers of leverage. So how do you think you push that down to people who are not in financial positions or not as financially savvy naturally or in that profession to start educating this at levels where they're starting to get financial literacy early on, and maybe you lead to situations like people have argued in Canada, part of the reason that they behave differently is they have a different level of general financial literacy throughout the people.
So
First, I'd like to challenge the retirement premise, please.
Amen, Roger.
So this is going to be the last question, so I'm going to just reframe it and frame it this way. What can be done to improve public support for sound financial policies, both the domestic policies that Bob was talking about and the global policies? I mean, maybe I just go around just one thing you think could be done in any arena that would advance that cause, that would make us a nation in which more people actually can understand and contribute to a stronger financial, domestic and international system.
Well, I'm going to take what's probably a slightly iconoclastic position on this, because I think you're going to get lots of financial regulation, because I think the populist movement that Sheila and others were referring to is going to continue to be strong. I don't think there's a lot of love of banks and financial markets, and I think politicians are by and large going to play to that movement. What I'm actually concerned about is activity does not always lead to the right result, and it's not taking away from the efforts that people have made. But people talk again about the politics of this as if, you know, it's just these big, huge vested interests resisting that. I'm sure there's some of it. But let me tell you, a lot of the politics on leverage are the idea that if you have a 20% down payment for home, then poor people that don't have the big savings but may have good credit can't get into a house. And that's a lot of what drove the housing market, so you had 5% or less sort of down payments. So to answer your question, I think the best thing that you can try to do is to try to improve the financial education of people so they have some sense about what they're getting into, whether it's credit cards, whether it's a home, and that partly is clearer disclosure as people have tried to operate as opposed to the boilerplate language. But part of it probably goes back to sort of basic economics education and people having some sense of personal responsibility. And that's where, again, at the last point, at the end of the day, you can have a systemic response, but we're in a society where individuals still have to choose. And at the end of the day, I'm wary of pushing this away too much from individual responsibilities, whether it's banks or companies or people.
Though we had a lively debate about where we are on too big to fail, I think the key is to ensure that finance works for the rest of the economy. 94% of U.S. jobs are not in finance, 94%. And even the other 6%, most of those aren't on Wall Street. It's really ensuring that finance works for the rest of the economy, and I believe, even though we might not be there yet, that there's a freedom to fail. Americans get it. If a big firm fails, that it shouldn't hurt me, somebody sitting in Kansas or Maryland. But I agree with Bob, we might not yet be there.
Well, I think one of the greatest challenges to the American financial system today is the enormous gulf between Main Street and let's euphemistically call Wall Street, and by that I mean the national financial system. And the antipathy on Main Street, deep and unchanged really since 2008, antipathy towards the financial system and towards the biggest institutions. And I think that those largest institutions have done a poor job in trying to win back some understanding and support from the public. I don't think they've done a good job apologizing or apologized at all. I don't think they've done a good job exhibiting sensitivity toward this antagonism, which is certainly in large measure or some measure deserved. And I think the leadership of the financial community could do a much better job than it has done in trying to bridge this gulf.
Well, since we're at an educational institution, I would, the role of schools like this one. And, you've got a project underway to enhance financial regulation, understanding the stature of financial regulation, the status of financial regulators. I remember I taught from 2002 to 2006 at the University of Massachusetts Eisenberg School of Management. And when I was engaging with the dean about what courses I would like to teach, I wanted to offer an undergraduate course in financial regulation. And I got laughed out of the room. Well, nobody wants to know about that. These kids are here to make money. So, fine, make money, but do it in the right way, provide real value, and understand the legal structure and regulatory structure under which you need to operate, and respect that. I think there are other pressure points in the system. For instance, I talk a lot with CFOs. I think CFOs were hurt. They got their credit lines pulled. They couldn't roll their debt. They couldn't access credit during the crisis. And I tell them, why you couldn't do that was because the banks you were dealing business with didn't have enough capital. They were fine in good times, they were not good in bad times. So I think explaining to people, drawing it to how it impacted them in real life and why these changes are important to them is really essential. And I'm writing a book for young adults about the crisis too. It's more focused on borrower behavior because I think, it wasn't just all the institutions. There were some innocent borrowers who were horribly exploited. There were some people who really gamed it. So. And that sense of individual accountability has to be there too. So I think we need to get creative and be committed and focused. But again, schools like Yale have a very leading role to play. We need to get the kind of good citizenry and corporate responsibility and understanding. Yes, it's fine to make money, but do it the right way. Don't do it through hidden fees and taking a lot of risk with other people's money. Provide things of real value. Do it responsibly. I think we can move the agenda ahead, but there's still a lot of work to do there, I think.
Yeah, I'm going to interpret your question just slightly differently.
Please.
Because I think it's a very large question. Thomas Jefferson said that democracy in a democracy, difficult decisions aren't going to be made unless, this is a paraphrase, obviously, unless elected leaders feel they're being held accountable by an informed citizenry. And I think when it comes to issues like fiscal discipline, trade, the various regulatory issues we've been discussing, and have a balanced approach to them, because it is true that everybody hates banks. On the other hand, banks lend money, and you have to have some kind of balance and figure out what's your regulation, how do you balance that against the needs to meet the borrowing requirements of a global economy. All of these things, Jeff, are very complicated, they're very difficult, and I think we need to have vastly greater public understanding if elected officials are going to be held accountable. And so I'll give you one view, whatever it's worth. I think the social media have had a pernicious impact, because I think that, I know this is somewhat controversial, but it's my view. I think they become an echo chamber for partisanship and for ideology. I keep having the hope that that someplace along the line, there will be a real force to use the social media to, in a not with philosophical orientation or partisan orientation, but rather in a neutral fashion, to educate the American people to understand the consequences of our fiscal situation, understand the consequences of trade, understand the complexities around regulation and all the rest, so that we then have more of a political support for and pressure on, if I might add, elected officials to make the kinds of decisions that we have to make if we're going to succeed as an economy.
And you had the first word and the last.
I am conscious I'm staring at a clock down there that says 0, 0, 0.
That's 0 hour. That means you're on the spot.
I can't answer all these questions, but I'm struck by what Roger had to say. The earlier question about all the debt, I mean, my example of the excesses of debt are not exactly debt, but credit default swaps, which were invented 15 years ago, new thing, in 2008 amounted to $60 trillion, presumably buying protection against maybe $6 trillion of debt. And you wonder how, well, the fact is, this is a money-making machine. Wall Street made huge amounts of money during this period, and they're not going to give it up very easily. It was made by the invention of the debt and the credit default swaps and all this other stuff. There are a lot of commissions involved in all this. Commissions make New York prosperous, that's for sure. Having said that, which sounds a little sour, because it is a little sour, but I think that's got to be corrected. You can't have an economy in which Wall Street at one point accounted for 40% of all the profits of the whole country, and that its normal kind of share of profits went from something like 6 to 12% or something in the space of 15 years. And there was something abnormal about all that, and we got to get back to something that's a little more connected, I think, with the real world, if we can say so. And I think this whole crisis we're working at it. And there's much more acceptance of necessary regulation than there was. I think the fiscal side, for all the ideological splits, and it's terrible in getting something done in government, there is a kind of common recognition, I think, on the part of the public that you've got to get the fiscal thing in order, and a big argument there should be about how to do it. But I'm not totally unoptimistic on that score. I think we are learning a few things.
That's a great place to stop. Let me